Yo, what's good people? This your boy Sean J, representing Debonair Millionaires. Today we're talking about what happens if you had debt and the banks or society was to collapse. Let's talk about that. So there's been a few people who have watched, some of my videos and saw that I was teaching people how to gain business credit and thought that,
hey Sean, what the hell? Why would you teach somebody how to get in debt? Like, what's the point? Like, why are you teaching people this?
I felt like the best way to answer this back was with a, response and video, so they can get all the information. Why I, teach people that. Yes, I know interest rates are up. Yes, I know inflation is up. Yes, I know the banks are collapsing. Yes, I know everybody in society is kind of scared right now. But that is why I'm teaching you. You ever heard that Warren Buffett quote where he says that,
be fearful when others are greedy, and greedy when others are fearful?
I'm trying to teach you to be ready and prepared. I'm getting you prepared for when you need to go ahead and, get that greed up. You know what I'm saying? Because people are fearful right here. I'm giving you that information so you're ready. I'm not giving you that information so you can abuse it. I'm giving you that information so you can be ready to use it. You know what I'm saying? I want to tell you first and foremost that we are actually lucky to have this credit system where we can borrow money or something that we don't have to get something that is worth something. You just got to use it correctly. There are many different countries where they don't have a credit system, where your down payment is your full price of your house, or your car or whatever you're going to buy. You have to put the full price. You have to save up for 20 years just to get whatever you need, or you build it yourself. We are in a unique situation where we're able to buy things that are worth something and not have the money at all. So this credit system is actually a great thing for you to learn. And right now, some people, might say, yes, the interest rates are up, but I'm telling you, if you buy the right things, it's gonna be okay. And I'm gonna tell you what happens to your debt. Now let's get into that. So let's start this off by getting a little education about what causes debt, which is the loan. All right, so in this world, we have three different types of loans. We have the installment loan, we have the revolving loan, and we have the cash flow loan. All right, so going over this, right, you got the installment loan. That's especially like, you bought a house or a car and you have to make monthly payments on this thing, right? That's an installment. Like, your payment, you're gonna continue to pay it, and that's what it is, right? Then next we have the revolving loan. The revolving loan is basically like you have a limit that you can spend out of an account or whatever, or a credit card or whatever, or a credit line, whatever. It's a limit that you can spend, and if you do not pay that back right away, you will have to owe interest on that loan or whatever. But it's basically like you can use it as much as you want. You always have this amount there. So I'm basically kind of teaching you that. But number three is the cash flow loan, right? The cash flow loan is basically like if you had a customer, right, who you invoice, right? So the amount of customers that you have, the amount of invoices that you have, and they still kind of owe you this money, they just pay it over time or whatever. A bank can see that and see that you're gonna have cash flow coming in and then give you a loan on that, all right? So that's three different loans that you have. Most of the time, you're gonna deal with installment or revolving loans, okay? So now let's go over what I think is the most important part of any loan, which is basically if a loan is fixed or if it is variable, right? This is the make or break, like especially during a recession. Like right here, this is really can either add to your plate or take off your plate. A fixed loan, right, is basically mostly a house, car. You have your monthly payment. It doesn't change because your interest rate doesn't change unless your taxes go up or something like that. But other than that, like your interest rate does not move. It's a fixed loan, right? So they're not getting any more money. Everybody knows what they're getting out of that one deal. Everybody knows you're getting that car and they're getting this much money from that one deal if everyone continues to pay and behave right in that relationship. All right, but then you have that variable loan. Like, say you have a credit card, right? Credit card, and you see 16 to 24%. That means they have a range to charge you in. Your interest rate is they can charge you anywhere in between the interest rate. And if they go outside of that interest rate, they have to announce that to you 45 days before they even do that. But the only way they can do that is, if the Federal Reserve continues to raise the rates or something like that, or if you don't make your payments. And I think you have 90 days not to raise your payments. But for sure, you need to make your payments. You won't have to worry about the variable. You already know what your range is. You know your high, you know your low. There's no bad about that. You already know what to expect. You know the best and the worst outcome with a credit card. There are other mortgage loans like the adjustable rate loan, or the balloon loan, or the jumbo loan, or maybe the interest only loan. So there's a lot of different loans, but we're gonna focus on the fixed and the variable, which the adjustable rate is basically the variable loan also. But just giving you a knowledge about the basics here. Lastly, what you should know about debt is that there are two different types of debt, which is the secured debt and the unsecured debt. Secured debt is basically like you bought a house, or you bought a car, or you bought like a bike, something physical, right, that you bought for that money that they loaned you. But if you do not pay your payments, what do? They can take that item that was worth whatever and sell it, and take it from you and sell it to someone else. So they at least can recoup their money. So it's not much of a risk. But there is unsecured debt. That is basically like credit card debt. So you can use your credit card to buy pretty much anything, right? So you can use it to take a course or something. They can't take that information from you. They can't take that course away from you. So what they do, they can either mess up your credit or sue you. So that's basically all they can do. So you got to realize I'm teaching you a strategy for the just in case type of thing, right? So I'm teaching you how to build your business credit, so you can then take that business credit and turn it into cash. You turn that cash and use that as your down payment to buy real life assets. We're turning our unsecured debt into secured debt that will make us money. And then once you buy that asset, you put it under your LLC, so it protects you, or it protects you from anybody trying to sue you. So this is a real life strategy. So now let's quickly go over what would happen to your loan or your debt if we experience hyperinflation or something like that, right? So first, let's break down hyperinflation, right? So you notice that the bread went up, the milk went up, the cheese went up, everything went up, the gas, everything went up in price, right? So if you bought a house, right, which is a secured loan, we broke that down, it could be an asset if you don't live in it, if it could be a rental property, right? So you bought a house, right? Before the inflation went up, what happened to the value of your house? Just like the cheese and the bread, what happened? It probably went up in price. If you bought a car before this inflation period, what happened to that car? It probably went up in price. People are paying more for less for the same thing because of the inflation, right? So people who have things of value, things that are real property or something that value, like that thing went up in price, and they could probably make money by selling that thing. Those people who don't, or just like renting, you probably experienced that your rent went up. So you got to realize that you have to amass things for them to go up in price during inflation. It's better to have things that are value than to have nothing or just debt. As long as you're buying something that is of value with the unsecured debt that I'm teaching, then you're gonna make money. It doesn't matter what the interest rate is, because we have already beat it, because we're already getting fixed products or fixed items or fixed property or whatever it is with the money that we're taking from the unsecured loan. You know what I'm saying? With that being said, it doesn't hurt you to have it. You know what I'm saying? It actually helps you more than hurting you. Now let's switch it over to the variable secured loan, which is like an adjustable rate mortgage, right? So that means that you bought a house, and in that first 5 to 7 years or something, you had the same payment, same interest rate, and then at that 7th year, they're going to change the interest rate to whatever the market tells or whatever it shows at that moment in time, right? So with that is really murky water, because you don't know what's going to happen during that time frame. Like, if people say they know whatever, the economists say that they knew that inflation was going to happen, but they did not know that COVID was going to happen. I like fixed rates, you know what I'm saying? Unless I know that I'm trying to do a flip or something, which I don't do flips. I go for the long run. I don't like not knowing. So what would happen to an adjustable rate mortgage if, we started to go through hyperinflation? When that happens, the bank, if anything, they will raise your interest rate, number one, which you can't really do anything. You sign the contract, and then also, everything, if you're still trying to flip the house, then, you know, all the materials are going up in price. All the, you know, there's so much things that are going up in price at the same time, which it will affect you, you know what I'm saying? So imagine having your mortgage payment go from $900 to like maybe $2,500, and you still have to pay for everything else that is going up in price too. So the bank will probably take your stuff and sell it. That's for sure. Last but not least, the variable unsecured loan, which is the business credit card, which is what I'm trying to teach you, right? So what happens if we experience hyperinflation? Well, just like regular credit cards, they're going to try to raise the interest rates, right? But, you know, they have to notify you also, and they would probably cut off some of your credit that you do have access to. So that's two things. But what happens if you can't pay it any longer? Well, they just do what they normally do. They would take your loan, put it in a batch of loans, and try to sell it off to, you know, one of those collection companies or whatever. So they sell it for pennies on the dollar. So with that being said, if everything was to fail, we had hyperinflation, yes, you would experience bad credit during the time, but also with a business, you can also do a bankruptcy under the business. You know, you don't really have to include you under there. Like, let me just give you an example. Donald Trump, 7 times, still okay, still made president. So, all right, you will be okay too. All right, you will be fine. If we are experiencing hyperinflation, you can't pay the bills no more. Hey, bankruptcy. Donald Trump, like I said, Donald Trump. But other than that, let's go into if, you know, society was to collapse. What happens to all these debts? Well, number one, what happens to the debt? If the bank collapses, what happens? All right, if the bank by itself collapses, what they will try to do, if it's a good loan, they would sell it off to another bank, and then you have to restart your payments back up with that bank, which just like your mortgage. You start off with one mortgage company and you end up with another mortgage company. They keep selling your loan off. You still own the same thing. They can't move the price. It's fixed price anyway. So that's just how it goes. Right? If you are in the bad loan bucket, which is you're not making your payments, they're going to try to do the same thing. They're going to put it in a bucket of loans and try to sell it, right? They're going to sell it for pennies on the dollar. And then if anything, right, they may try to sue you. If you're not paying anything, they may try to sue you. And if the whole thing collapses, you're not going to lose. You're the person using the money to buy assets with. As long as you got those assets and, you know, they're making you money, there's nothing to fear. There is no atmosphere where this does not work. You understand? So I'm teaching you this so you can be prepared for anything. As long as you have those assets, they're going to go up in price. With that being said, I hope this gives some clarity about, you know, the information I give you, you know, because I know it's a scary world. I know you probably scared of credit cards. I know you're probably scared of credit. But if you learn the system, you know what I'm saying? Learn the system. Or I will teach you, you know what I'm saying? Let me know what you don't know. And I can teach you anything. The consumer law, anything that you need to know, I can teach you, all right? So, but this your boy, Debonair Billionaires. I'll holla at you.